So I just wanted to start recording here. So we haven't done one of these segments in a while. Paid lunch, September 2nd, beginning of fall, almost end of summer, 2021. It's got Jman on with me. We're going to talk about a credit spread, and then I'm going to talk about the BLS data coming out tomorrow and what kind of impact it may or may not have on the market. So I brought Jman on because he was looking at doing a credit spread yesterday at Melly. And I believe the short position that you were asking me about was what? What was the strike?
Well, the short was 1905.
Oh, okay.
Yeah.
So now that if you look at folks, if you look at the market right now, this is at 12:30 Eastern. It's trading at 1956. So that's why I suggested to him maybe that was not a great trade. But anyway, go ahead and talk to me, J-Man.
Okay, so that was a short expiration. That was expiring this Friday.
Right.
And then I had the long on September 17th at 1980.
Right.
Strike. I guess my thought was I didn't expect it to move so quickly. I thought we were due for a move upward. Getting close to that 2000 in the 2000s. I think someone else had posted something similar, and I guess I was trying to lower my trade costs, so I was thinking of setting it up that way, and it would have crushed me today.
What was the short strike?
The short was 1905.
Okay, so you can tell by
that a 45 delta.
Here's the 1905 right here. So he threw this up yesterday. The expected move actually was somewhere in this area yesterday. That's how much the options prices have changed the expected move in a day. But so it was right in the middle, maybe a little bit skewed up on the expected move. But that was the first thing I noticed on it. Second thing I noticed on it was the spread was 49.30 and 56.70 on the bid ask. Open interest of 9 contracts. There's 9 people in the whole world that have those contracts. So I suggested maybe we find a better trade, right?
Yeah.
And so the thing about it is that, and I'm going to review this really quick, folks, is there's 3 things you need to check the box on before you even think that this is a potentially decent trade on a credit spread. One is it's got to be outside the expected move, okay? So if it's a call spread, it's got to be from, if it's Melly, 1990 on up. If it's a put spread, 1915 down. That would be if you're going to play it this week. So that's job one. It's got to be outside the expected move. Then you got to find a decent volume and open interest and Melly, I mean, you can make money on this, but there's a lot of luck involved in making money on Melly in the option side of it because.
Richard, could you repeat that again? The first step.
Well, if you need to pick your strikes. Let's say you want to do a call credit spread. You want to pick your strikes that are outside the expected move. So we know this is the expected move right here for Melly up until tomorrow, 1920 to 1980, right? We can see that. See that, J-Man?
Are you sharing something?
Oh, I should be, and I'm not.
Okay. Thank you.
Thank you for telling me.
No problem.
Should be in the screen now.
Yes.
Okay. So here's Melly. And you can see here that yesterday, we'll go over the review, he wanted to do it at this point in time yesterday when we talked about the trade, this particular expected move band, this brownish ruler looking thing, that was actually in here somewhere because Melly's moved. So Melly's moved quite a bit. So the expected move moves along with it because the option prices go up in value, and that's how they determine the expected move. They're looking at the current value, the current move based on the price of this plus the price of this. Okay,
but this is the expected move now, right?
Right. I mean, correct. It changed.
Okay.
How the expected move is calculated is that you take the at the money call and at the money put, right? And that will tell you in total what this move is going to be. So $20 plus 13, so $33. Right? Make sense?
$33 from where the position is now.
Yeah.
Yeah.
Approximately.
Okay.
Approximately. So, sometimes that they can be, it's a range, right? But approximately, if you take the straddle price, is you buy a put, you buy a call at the money. Where's it at right now? 1950. You buy a put, buy the call at the money. That kind of gives you a pretty good idea of the expected move. Okay. So
that makes
So the first step is when you're putting on a credit spread is you got to decide whether it's a bullish play or a bearish play, right? So a bullish play would be you're selling puts because you're expecting these to go down in price, right? These puts over here, and if you're bearish, you're selling calls because you're expecting these to go down in price. Okay, so once you've made a decision as to what direction you think it's going to go, let's say it's bearish, you're going to want to set up a trade that is outside the expected move, right? And the expected move is here to here on this week's September 3rd expiration mellies, right? So that would mean that at the very minimum, you'd want to get out to 1900 as your short strike. But 1900 as your short strike, and then depending upon how much risk you want to take, you can move your long strike down to 2000, 2010, 2020. But once now we've made a decision, we're going to go short on this, meaning we think we're bearish. Now you're taking a look at this particular contract. Look at the spread, 296. I mean, you're not going to get a favorable fill. So you're never going to get a credit like that. So it's got to have enough volume, and it's got to have enough open interest that would create a spread that's very tight. Let me give a different example. Let's take Apple. Okay, here's Apple's expected move this week, right? Not much. 1 day left to go. That's how much they think it's going to go. Okay, but take a look at if you wanted to play this outside the expected move. Now it's not going to pay much right now because it expires tomorrow. But let's just say we take the 155s, right? You're paying, the spread is a penny, right? Spread is a penny. That's because you have look at how much volume and how much open interest you have here, 198K, right? Let's pop these out and go out to next week, let's go to September 17th, which is a more reasonable thing. So look at the volume on this, 16,000 traded today, 96K open interest. You're outside the expected move. Spread is 70 cents versus 71 cents. So it doesn't. You're going to be able to get into this and get out of this trade easily because you've got a good spread there. So that's the first. So you have to go outside the expected move, and then you have to find liquidity. I don't look at Melly as a very good play for credit spreads. Somebody have a different opinion, I'd be happy to listen to it. It just doesn't have the liquidity, and as a result of that, you wouldn't be able to get out of a bad trade if you needed to, right? So with this one, you can get out of a trade easy. I mean, let's just say we go to 160, sell the 160s, buy the 165s. Okay. Even the spread is tight, 43. Even when you get the spread, the spread on the spread is tight, 43 here. 45 here. All right. So at the very most, you're giving up 1 penny or $1 in premium to get into the trade, and maybe $1 to get out of it if you need to get out in a hurry. That's the kind of liquidity that's great for trading credit spreads, right? So outside the expected move, and have enough liquidity and have enough volume in it so that you can move in and out of the trade. And this particular trade, you got a 90% chance you could have a profit of 50% or more on that. So chances are you'll pocket $21 on this per contract. Does that make sense?
It does. Yeah, I completely structured that wrong, and the liquidity is a major issue for that.
Yeah, I don't like to play any. I personally don't like to play any options chains, whether it be a naked call, a naked put, a credit spread, a debit spread, iron condor, or whatever. Pick something. Pick any particular options strategy that you want to put in place. I don't like playing anything like that unless there's liquidity, right? Now I do know some hedge fund guys that trade Melly, and but they're almost exclusively sellers of premium. So, I know guys that will sell because of the way the tick moves. I know hedges that will just go to Melly as an example again. Let's go to October 15th, and take something like this, right? A 19, where's that? 1949, 1990. Shit, that's really bad there too, isn't it? Well, let's go. Let's go to October. Let's go to October. October 15th. Um, See, they don't even. There's not even an expected move put in here. See that?
Hmm.
That because they don't have. They don't have any confidence in the liquidity that they can estimate the expected move.
Right.
So because of how big the spread is here, $91 to 98.80, right? So I know hedge fund guys that will sell these premiums here, right here. They'll sell these premiums, but what they'll do is they'll say, okay, it's at 1949 right now. I'll sell the premiums, right, almost at the money. I'll sell them, and then they'll wait for that 1 day move when Melly pulls back to 1900 or 1880 or something like that, which will happen before October 15th, right? More than likely. And so they'll just sit on that. But what they do is they go in and instead of, let's say they take the 1960s, they wouldn't do it with this one here, but maybe let's take the 1990 because at least you got 14 open interest there. So let's say here's what your the bid on 774.90 is the bid on the if you want to sell it. But what they'll do is they'll go down to here, and they'll try to get $80 out of it, right? $80 per contract, and sit on it if they get a fill. If not, then they don't take the trade. But that's it's an easy. I think you mentioned that it's an easily manipulated. And I don't think those guys at Tasty meant it manipulated illegally. I just think that it's easily manipulated by people who have a substantial amount of experience in how to manipulate low liquid options contracts to their benefit. I think is that what the guy was trying to say to you?
I think the second guy said something different. That it was more about the liquidity that they like to make sure they take those types of trades over the phone and not online.
Yeah, because the guy wanted to explain it to you what the risk was in case you didn't see it, right?
Mm-hmm.
Right. So I mean, it's much different. You can see it's much different playing this one than playing this one, right? Volume, open interest. So that's the whole point. So, but even forget about before we even got to look at what the open interest or the volume was in the contracts on the chain you were looking at on the Melly chain, you were inside the expected move.
Yeah, that was my first mistake.
So, right, yeah, and that's the first mistake. So you need to be, and you can see in a real world example, 24 hours later, what would have happened to you, right? It wouldn't have been fun. It wouldn't have been fun.
No.
It wouldn't have been fun because it's trading at 1951, and I think your shorts were 1905. Is that right?
Yeah, 1905.
Right.
Or 1910. I forget
Right.
which one.
Right. So anyway,
In 1905.
all right. So yeah, does this help you understand? Does this help you a little
Yeah.
bit?
No, it does. It does. Thank you. You saved me some cash. Appreciate it.
Yeah, you would have been maxed. You'd have taken a max loss on that today. So and the thing about it is that I know that he's not here today. Who's the guy that takes the Amazon credit spreads all the time? He's probably sleeping in. He's a young guy, lives in San Francisco, but he was he takes short term credit spreads, I'm not a fan of them only because, not because they can't work out for you, because they can, and they can work out very well. But there's no time to fix the trade. You know, you have to give yourself a little bit of time in case the trade goes against you right out of the box. Which, yeah, air exits, as Oppo was saying. Yeah,
I had the long out further. See, I was thinking that the short would take time before it moved. The short would expire, and then I would catch the long on the move.
Okay.
That was kind of.
I kind of figured. I kind of figured you were. That was what your thinking was. So. Anyway.
Yeah, but it moved too quickly. So.
I probably need to do a redo on teaching that class, which I promised to do. I got a lot of promises I've made and haven't completed yet, so I got a laundry list. But anyway, stick with me for a minute. You got a few more minutes?
Yeah.
Okay, so I'm going to go over what the market is doing here this week and why it's doing it. First of all, the manufacturing index numbers came out yesterday. It looked very favorable. And by doing so, they showed that this tightening, this choking of the supply chain is starting to loosen up. That essentially was one of the very big things that caused people to try to determine whether or not this inflation we were looking at, increase in prices, was going to be temporary or going to be long-term, and it's going to continue to climb. That number shows that it's probably more likely to be short-term than long-term. That's good for the market because that means that Powell's not under inflationary pressure to start doing easing. Second thing that happened yesterday was the ADP jobs report came out. Now, what they do is the ADP basically reports their estimate based on the poll that they do of private payrolls increasing over the course of the previous month, okay? And it's a precursor to the actual government release of the jobs data that you'll see on Friday called from the Bureau of Labor Statistics, BLS data. Private payrolls were estimated by ADP last month to be 600,000, right? They ended up coming in at 374. That's a big miss, okay? Now, at the same time, today the numbers came out for new unemployment apps that occurred for the month. Those went down.
Lowest since the pandemic started, right?
Right. Beer, I will do that, Beer. So yeah, lowest since the pandemic. So what you have now is you got inflationary thinking temporary. You got the jobs data showing that there's a lot less people that got a job or payroll increase last month than not. That historically always ran almost in sync with what you saw from the BLS on Friday. There's been a diversion on that this year. It's been crazy. Some months they match up, other months they're completely mismatched, and I don't know why that is. So I got a couple of those conjectures, but you can't really statistically prove why that's going on. Then today we get a thing that says less people applying for unemployment, and then we have the jobs report tomorrow. If the jobs report comes out like the ADP report, the market will shrug it off and it'll probably go up a lot tomorrow. If for some reason the jobs report is way much better than expected, then the market may take a hit tomorrow. Okay? I get the sense now after seeing this data that they're going to, and knowing that the unemployment benefits across the country, these extensions are going to fall off on September 1st, meaning yesterday, right? That was the day cutoff. That Powell's going to start pushing to look at the September jobs numbers before he opens up a conversation with his governors, and he runs that show with his governors that says we need to talk about what we're going to do from a tapering standpoint, and we need to wait until we get the September numbers in before we have a serious conversation about it. I think he's going to push it off by a month. That's my opinion. Unless tomorrow it rips. Unless tomorrow those particular things rips. Okay. So the ADP numbers that we saw, I think that if they're in sync with the BLS, they're pointing to a softer labor report that we're going to see. Okay. So, and in fact, I'm looking at the Goldman report right now. They're saying they're forecasting below the consensus of 600. So they're already going out on a limb, quote unquote, after having ADP data, saying that they think it's going to fall. It's going to be below that number. The payrolls, but the payroll increases. The only thing I can think of, because that shows the total number of dollars being used on payroll increases that maybe had that, was that there's a lot of jobs re-added in the month of July in the service industry, restaurants, stuff like that, and those jobs pay less. So that's where the mismatch might be. So let's just see what comes in for tomorrow. Be prepared for a wicked day. Be prepared for a non-wicked day. I think you got to be. I think we could see volatility to the upside. We could see it to the downside. It'll all depend on what those numbers look like, and those numbers will hit if you're an options player before the market opens. Does that help you guys?
Yeah, I think so.
So that's my thoughts on it. I'm sticking with it. What are my plans on apps? Okay, so I hope you guys closed your app shorts if you had them when Sornak did, because I'm thinking this thing's going to keep climbing step by step until September 9th. Right now, my plan on apps is that I see resistance, very, very strong resistance at the 66 number. If it pushes through there, I don't see anything stopping this. If it pushes through there with volume, I think this could very easily go up to 72, potentially 74, 75 by September 9th. So my plan, since I'm holding January 2023s, is to continue to hold them. I'm at 60 and in the money. Going to continue to hold them until September 9th, unless something goes haywire on the ticker and we just got to run for the hills. So that's my thought process right now. Does that help, Veer? Let me just, I don't think he's on voice. Let me just answer this. Let me just answer this in, if it goes above 66, what did I say, 71? Strong by 72 to 74. 74 by, whoops, what happened here? Mouse fell down, everybody went off the screen. 72 to 75 by the 9th. All right, so there's our paid lunch for today. 20 minutes in. We haven't done one of these segments in a while because nobody was listening to them. It's the recordings. So let's see how many people listen to this one, and I can see if I want to keep doing. Maybe I'll do them a little more often. But I think part of it is I'm just repeating myself every day. So what am I playing today, by the way, since I'm on here? Myrna, I'm in that heavy. Apps, I'm in that heavy. Facebook, I'm thinking about adding here. Sava, I've got common. Spot, I sold about $22 ago. I think caught the bid on that news out of Apple today. So I've looked at maybe re-adding a position today. I missed Netflix today. We should have probably taken that right at the open because it had not moved on the news from Apple, but Spot already had gapped. Where's Spot now? $17 up, yeah, 255. I think it's got more room to go. It's not even at the 200 SMA yet. See if when it hits there, that might be the first level of resistance. If it busts through there, then I think it could run even more.
That was a good trade.
Yeah.
I took one of those, and I think I was like a 5x on that.
When did you take that?
See.
like 2 weeks ago, or
Yeah, I took it. Sorry, I'm just trying to.
at the like the 200, 205, 210 level?
I bought it. I'm looking on my phone, and this it doesn't really show. It's like filtered. It's kind of weird. It doesn't show me more history.
That was a good one though.
Yeah, it was good. It was really good.
Did you have it overnight?
Yeah.
Yeah,
I,
yeah. 'Cause
I,
it
I got it. I got it on the 23rd.
Okay, cool. Yeah, so I got. I mean, I missed this last move up because I had it like 26, 27 being as resistance, and I had made a bunch of money on the trade. I had options and common. And so I kind of thought, you know what, it started consolidating for a couple days. I thought, you know what, this may push back a little bit here, right? And it did consolidate for a couple days, and I sold it, and then it just ripped. Now, of course, the news today, the gap up today is almost exclusively off the news, so which is something you can't predict. But I said, and in fact, if you look back when I originally took the position in spot, I said, this thing's way undervalued, and I don't know when it's going to go, which is why I started with common, right? Because I don't know when it's going to go, but it's going to go. It just needs a catalyst. The problem with catalysts is you can't predict when they're going to happen. Well, we saw what happened here. So, a little
Yeah, I got out today when I was kind of couldn't break that 255. I figured it was giving up, but it looks like it still wants to.
Got a lot of momentum here.
Yeah.
I don't know what this number means. I don't know what that revenue number means to them by having access to Apple Play. Obviously, to me, that makes more sense and is more valuable to them than Netflix having access to that. Because I mean, how many people watch movies on their phone? I don't know. Or I don't know. Maybe I guess I don't know enough about it. Stealth is kind of the expert on these online revenue dealies. So anyway, so that's it for today. 25-minute session. I'm going to record it. It's going to be on in paid lunch in about an hour. It takes a while to download it. Jman, if you have any other questions before I go on the credit trades.
No, I appreciate you saving me again, and those are good points, and I look forward to trying to implement that.
Yeah.
Now my trade.
And for anybody that's listening, if we have a recorded session already in the podcasts on running credit spread, so feel free to go back and save yourself some money by doing it right.
Thank you, Richard.
You bet. I'll talk to y'all later.
Thank you.
I'm gonna go record this, and then I gotta run an errand really quick. That's the end for today. Talk to you soon, everybody.